Hello everyone, how's it going? If you're looking to buy EVOFEM Biosciences stock, then please keep watching this video until the end because we're going to look at the company's recent news, how's the market treating it, what are the technicals telling us, and most importantly, what should be a good or the best trading approach. As the market is still very volatile for the moment, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. EVOFEM recently took off in the small cap market, and it attracted a large quantity of investors into the company hoping to benefit from large and additional upsides. So EVOFEM has been able to develop products with the potential to disrupt the sector, and that really sent the company's equity value to much higher places. I believe that the stock will benefit from additional upside momentum as long as it keeps to give us additional reasons to believe in its future. On the other hand, I recently mentioned that if EVOFEM remain an interesting purchase target, we should always be wary or at least ready for the scenario of a potential retracement, which is likely to happen. Because frankly, it's not difficult to imagine a lot of shareholders wanting to realize this gain, as the price action of EVOFEM really hasn't given investors a lot of reasons to hope for a better tomorrow over the vast majority of its existence. So with that being said, I believe that this is a company that can truly have the potential to revolutionize the sector as long as we give it enough time to keep going. We must also remember that it also applies to us, the traders, to control our positions and the tendency to be too preemptive in the decision, whereas the short-term volatilities may force the position to be sold. Now, let's also take a look at the technicals of the stock. The trading volume of EVOFEM has recently been around 6.8 million shares versus an average volume of 22 million shares. Over the previous 52-week period, the price fluctuated between 28 cents and $14.61. The volume of shares traded can tell us how many shares are being bought and sold at any given time, and if there is enough liquidity to support our trading strategy. If the float is very thin, it would be very easy to influence the stock price, but with very low liquidity, it could be difficult to exit the position. When we compare the current volume against the average volume, there might be the possibility for a trend reversal or breakthrough if the difference is very large as well. So for example, if the stock were to break through, the current volume could be significantly higher than the average volume. The market cap of EVOFEM is currently around $37 million, compared to an enterprise value of $174 million. Simply put, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles, meaning they're not items or stocks that a company can use to generate income, but secondary items that provide growth potentials for the future, such as pledges for major contracts, blueprints, intellectual properties, goodwill, and so on. For most startups, their valuations are mainly based on how much those intangibles are worth. And if they were valued in more favorable market conditions, this could mean that there can be a huge difference between a market cap and the enterprise value, giving a false impression to the market participants that if, let's say, we're in a bearish market, the company might be trading at a discount. But this is only trading below the book value, and it doesn't mean that the market itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and only deflating back ever since. As we compare the current price to the historical price fluctuations, the stock is around 24% higher than the 1-month low, 212% higher than the 12-week low, and 212% higher than the 52-week low. On the options market, giving us a hint about the market sentiment of where the stock price is likely going to go next, the implied volatility is 204% versus a historical volatility of 350%. Regarding the shareholder structure, institutional shareholders own about 56% of the outstanding shares. The biggest shareholders include Vanguard, Mirador, and BlackRock. Usually, it is best to see some institutional participation when holding a stock for the long term, because it offers a layer of stability, and it's also a token of reliability in the medium to long term. This means that the market believes that this company can deliver more value in the long term than simply trading the ups and downs in the short term. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there are many exceptions to this rule, as there are always great companies mostly owned by retail traders as well. Let's take a look at the short interest of the stock, which is the number of positions aiming to profit if the share price falls lower. The way it works is that short positions will borrow the shares from the broker, sell them in the market, and buy them back later, profiting from the difference between the two timings. If there are a significant short interest, usually above 25 to 30%, there could be potential for a short squeeze, whereby traders will buy the stock up, forcing those with short positions to redeem their positions to avoid further losses, acting as a buy in the stock market, which is what people refer to as a short squeeze, and this became a popular concept in recent times, with stocks like GameStop and AMC being successfully short squeezed. The current short interest is about 35% of the total float, and 51% of them are coming out from the dark pools. Usually, if the short interest is above 20%, with a significant portion of the short volume outside of the public exchanges, this could suggest that there are institutional positions taken to short the stock and that there would be potential for a short squeeze. I would recommend to keep a small position in EVOFEM and to reserve about half of your allocation over the next 6 to 9 months to gradually buy in the stock in order to remove the short-term volatility risk. I would recommend to commit between 1 to 3% of your portfolio, and would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, Capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.